Hi folks, how you doing? Time to take a look at some of these questions with deferred tax assets and deferred tax liability. This is all from chapter 17. Okay. So the first thing you see here, this is a chart. These are some pretty common. So these guys right here. Let me make this a little bigger. Maybe see it a little better. Come on, bigger, bigger, bigger. Okay, there we go. That's better. Okay, so anyway, these are very typical book tax differences. So notice here, if your tax depreciation is greater than your book, it makes a deferred tax liability, and you wind up subtracting of that to make the adjustment. Okay, and so basically here's a list of a bunch of different ones. By the way, this would definitely be handy for you to have when you go to take your test. Okay. So, and then here, this guy right here, these are some quick rules, okay? So these two items right here, I would definitely have handy when it comes time to take your test, right? Just to make sure you keep it straight, because it can be a little confusing. So let's take a look at some problems. And by the way, so if you could work these problems out, then you're in good shape for your test, okay? So you'll see very similar ones on your test. So let's take a look at the first one. So in the first one, we have book tax income, pre-tax book income of $600,000. Now we have a permanent difference. Permanent means it's never going, it's never going to balance out, and the reason why has to do with that two complete different sets of rules, and it's not a matter of timing. So one permanent difference is $15,000 in meals. So if you remember the non-deductible portion, we're going to have to add that back in. Okay. Then we have a temporary difference here where depreciation tax exceeds book by $50,000. So we're going to have to subtract that in order, and again, you could take a look. So here, tax exceeds book, right? And if you go right back up here and said tax greater than book, subtract it. Okay? And then here, meals, permanent, add it. Okay, so where you go back down here and you go, okay, so we're going to add this. This is going to be a plus. This is going to be a minus. And then over here, bad debt expense, book exceeds tax by 20. Now, if you remember, we talked about in class, bad debt expense, that's the estimate that you're talking about when it comes to your book, but tax only wants to know about it. So again, this is going to have to be added back in. Okay? All right, and then we're starting with the deferred tax rate's 21%. We have a deferred tax liability of $4,000 and a deferred tax asset of $1,500. Okay, so let's do the solution. So here's our $600,000 right here. Then we add in the $15,000 from the meals. We subtract the $50,000 for the depreciation. Then we add in the 20. So $585,000. This is our taxable income. So our current tax expense would be that number by 21 gives us $122,850. Okay. Now let's take a look at our deferred taxes and assets and liabilities. So we have the $50,000 here times 21% is $10,500. Then we have a deferred tax asset of $4,200. When you net those two together, you have a net total deferred tax liability of $6,300. So one of the things when you do that netting process, you're going to know that there's a difference here. Okay, now let's take a look. So that's what the current part is. Now let's take a look at the deferred part that we started with. We came up with, we had 4,000 and then the 1,500, so we wound up with 2,500 as a deferred tax liability. So our total here was 6,300 minus the 2,500 that was there, so we're going to have a $3,800 expense. So for the total tax provision, you're going to have $122,850, which is what we calculated, plus that deferred tax liability for total tax provision of $126,650. This is going to be your income tax expense. Okay? And then the effective tax rate, you take the 126,650 divided by 600,000. This is your effective tax rate because this is your book amount, book income. Okay. Now let's go take, what does the journal entry look like for this? Well, the income tax expense, this is what we calculated here with two of them together. So basically, this is our income tax expense. We have a deferred tax liability of $3,800, and that has to basically do with the combination of our current ones plus what we already had on the books. And income tax payable is right here. This is going to be, this is what the IRS wants. Okay, that's what they want to get paid. All right, so there's the first one. And they mostly are going to go along these lines. So if you follow those rules up above and you can do these, you're in good shape. Let's go do another one together. Okay. Here, problem 2, pre-tax book income is $450,000. Okay, now we have municipal bond interest, $5,000. Well, you know that's not taxable, right? So if you take a look what happens down here. We wind up subtracting that because we're trying to calculate the taxable income. Okay. Now, rent revenue. Our tax exceeds our book by $30,000. Again, with rent revenue, the tax people are like, well, did you receive the money? And you're like, yeah, but we didn't earn it yet. And they're like, well, we don't care. So we're adding that $30,000. Okay. Then we have an accrued bonus. And here, the accrued bonus, the book exceeds tax by $18,000. Okay. Now, if you go up here, temporary difference, accrued bonus, let's see if we got a rule here. And the rule is accrued expenses not deductible yet. It says to add it back. Add it back. Okay. So right down over here, we're going to go and we're going to add that back. And so now we get $493,000. Okay. Our current tax expense, $493 by 21%, $103,530. Now we have these two items right here, this one and this one. Okay. First thing we're going to do is we're going to calculate, we have the $30,000 times the 21% deferred tax liability with the L of $6,300. We have a deferred tax asset, $18,000 times 21, $3,780. When you net these two together, you have a deferred tax liability of $2,520. Okay? The beginning, we had a net deferred tax asset of $500. And by that, they mean here, we have a net deferred tax asset between these two. So 3,000 minus the 2,500 is 500 DTA. Okay, and then when you go down here, everything we had was DTL. So when you subtract it, 2,520 DTL minus the negative 500 gives us a 3020 tax expense. So our total tax provision is going to be the 103 plus the 320 for 106,550. Our tax rate is the 106,550 divided by 450. This is book. Okay, so there's our effective tax rate. Our income tax expense is going to be 106,550. How are we going to take care of that? We're going to pay the IRS $103,000. And then the other part is going to be this deferred tax liability of $3,020. Okay? All right, so make sure you can do that. This one could be a little confusing here. So 2,500 minus the 3,000 comes to a negative 500. And you always subtract this item right here. So 2,500 minus gives us this expense. Okay? All right, folks, that's the first two problems. We'll be back with some more problems in just a minute.